Good morning, good afternoon, good evening, and a warm welcome to all distinguished participants around the world. On behalf of Prudence Business School, I welcome everyone for joining today's insightful executive briefing session on a very important topic in today's times: letters of credit, common errors, risks, and payment failure traps. Why documentary precision matters more in the 2026 geopolitical trade environment. This important topic is presented by Mr. Niraj Kumar, a seasoned banking professional specialized in trade finance solutions for business corporates across diversified sectors. I'm Dr. H.C. Barkey, President and CEO of Prudence Business School, headquartered in Silicon Valley and focused on global risk management and insurance education. I also had Prudence, a specialty global Lloyd's of London insurance and reinsurance broker with offices in the US, UK, and UAE, and catering to over 1,000 business corporates and diversified sectors across the globe over the last plus 21 years. Before we start, I take this opportunity to express our special thanks to my two dear friends and industry veterans, Mr. Vincent O'Brien, Director of the International Chamber of Commerce, UAE, Chair of the ICC Banking Commission, Market Intelligence Group, and Associate Director of the Institute of International Banking Law and Practice, and Mr. Shashi Shekhar, Group Chairman and Founder, Supply Chain Logistics Group, SCLG, part of the ICC UAE, in supporting today's webinar initiative. In today's increasingly volatile world of global trade, businesses are facing unprecedented challenges arising from geopolitical tensions, supply chain disruptions, sanctions compliance requirements, rising freight and shipping costs, and heightened risks across major shipping routes. While letters of credit continue to be one of the most trusted payment mechanisms in international trade, many business organizations underestimate a critical reality. Payment under a letter of credit is determined not by the quality of the goods shipped, but by the quality and the accuracy of the documents presented. As we will learn today, many LC payment failures occur not because of a counterparty default, but because of avoidable operational errors, documentary discrepancies, timing failures, transport documentation issues, compliance concerns, and weak drafting at the contract and LC issuance stage. For business corporates, these mistakes can result in delayed payments, increased working capital pressures, additional cost, and significant financial exposure. This makes LC governance not merely an operational issue, but a boardroom and executive management priority. We are privileged to have with us today an outstanding industry practitioner, trade finance leader, and my dear friend, Mr. Niraj Kumar. Mr. Niraj Kumar is a seasoned senior banking executive with more than 15 years of leadership experience across trade finance, factoring, supply chain finance, trade receivable finance, and cash management in both the UAE and India. Most recently, he served as the head of global transaction banking at the United Arab Bank, where he led the bank's trade finance, supply chain finance, and cash management business and played a key role in developing innovative working capital and trade receivables financing solutions for corporate clients. Throughout his distinguished career, Mr. Niraj Kumar has held senior leadership positions with the United Arab Bank, Noor Bank, Emirates NBD, ICICI Bank, and HDFC Bank. He has extensive experience in trade finance, structured solutions, trade credit insurance partnerships, supply chain finance, factoring, and transaction banking, making him exceptionally well qualified to guide us through today's important discussion. Ladies and gentlemen, please join me in welcoming Mr. Niraj Kumar as he shares his insights on how businesses can identify, avoid, and manage the common errors, risks, and payment failure traps associated with letters of credit in today's rapidly evolving trade environment. We'll have about 40 minutes of presentation by Mr. Niraj Kumar, followed by 15 minutes of question and answer session at the end of this webinar. So kindly type your question in the chat box as we navigate through the session, and we will best answer them as many as possible at the end of this presentation. Mr. Niraj Kumar, the floor is yours.
Good morning and welcome. Thank you for joining this session today. Over the next 30 minutes, we are going to cover something that affects every UAE business that trades internationally. Letters of credit, specifically why they fail and what your team can do about it. This is not a beginner's introduction to trade finance. There is a practical briefing for people at the executive level who need to understand why documentary credit failures keep happening and why in 2026 the cost of getting this wrong has gone up considerably. The title says Common Errors, Risks, and Payment Failure Traps. And that's exactly what we will go through. Real failure categories, real UAE context, and a practical 90-day program you can take back to your teams. Let's get into it. Let me start with the single most important message of this briefing. LC capability is not a back office function. It is a board level enterprise risk issue. Full stop. Here's why that matters right now. In 2026, shipping through the Strait of Hormuz has become more expensive and more uncertain. Insurers have pulled or restricted marine coverage on Gulf routes. Carriers like Hapag Lloyd, CMA CGM have imposed war risk surcharges. We are talking $1,500 to $4,000 per container unit, depending on the carrier and cargo type. China to UAE spot freight rates are up 5% since mid February, sitting at around $1,572 per FEU. And that was before the latest round of tensions. These numbers move fast. What does this mean commercially? It means sellers, your counterparties, or you as the seller, are increasingly unwilling to ship on open account terms. Everybody wants the security of a bank undertaking. They want letters of credit because an LC shifts payment reliance from I trust this buyer to a bank will pay me. Here's the trap though, and this is the core of today's session. Many corporates negotiate LC deals perfectly at the commercial level. They close the sale, they agree the terms, and then they lose money at the document stage. Operationally, through their own errors. That is what we are fixing today. Now let's put the UAE in context because geography matters enormously here. The UAE is a re export hub. It handles transshipment for goods moving across the Gulf into Africa, into South Asia, and beyond. When Gulf shipping lanes face disruption, it doesn't just affect oil, it affects every commodity, every manufactured good, every container moving through Jebel Ali. About 20% of the world's oil transits the Strait of Hormuz. That single data point tells you why any Iran related escalation sends immediate shockwaves through freight markets, insurance markets, and ultimately through how buyers and sellers structure their payment terms. We've already seen shipping lines issue warnings about berth congestion, delays in pilotage and tug services, port clearance delays. These are not hypotheticals. When a major route reopens after disruption, the backlog creates its own chaos, and that chaos translates directly into document deadline pressure. And here's the executive implication. When your commercial team welcomes an LC deal because it means they can close a sale with a buyer, treasury, legal, logistics, and operations all need to be ready to execute it cleanly. That cross functional readiness is what most UAE corporates are missing. Before we go into the errors, we need to establish one foundational principle. Because if your teams don't understand this, everything else falls apart. A letter of credit is a bank undertaking to pay against compliant documents, not against the goods, not against the commercial deal, against the documents. I'll give you a simple analogy. Think of it like a vending machine. You press the button for the product you want, but the machine only releases the product if the exact coin combination matches. It doesn't care if you're a valued customer. It doesn't care if you've been buying from this machine for 10 years. It will not release the product unless the coins match exactly. Banks work the same way under documentary credits. They examine the documents presented to them. They check those documents against the terms of the LC. If everything matches, they pay. If anything doesn't match, a wrong date, an inconsistent description, a missing endorsement, they have the right to refuse. And here's the expensive mistake that keeps showing up. Companies assume that substantial compliance is enough, that if the goods are right, the bank will be reasonable. Banks are not commercially reasonable under documentary credits, they are contractually literal. That's the whole point of the instrument. And here's the board level takeaway. A profitable shipment with goods physically delivered and a satisfied buyer can still create a cash flow crisis if the documents are discrepant. Never confuse commercial success with documentary compliance. Now let's look at the data, because this slide makes a very clear case for why LCs have come back into favor. The Houthi attacks on Red Sea shipping in 2024 and 2025 were a turning point. When those attacks began, marine insurers started canceling or heavily restricting coverage on Gulf routes. Exporters globally, particularly in Asia, started refusing open account terms for shipments destined for the Middle East. LC demand spiked. The ICC Trade Register, which covers roughly a quarter of all global trade finance transactions, consistently shows that documentary credit default rates are extremely low. We are talking about import LC default rates that went from 0.64% in 2020 down to around 0.24% by 2023. Export LC defaults stayed below 0.05% throughout. Now compare that to a corporate loan book. Compare that to factoring or receivables finance. The credit risk profile of LCs is extraordinarily low. The chart on this slide shows that visually, and it tells you why banks like writing LCs and why sellers like getting paid under them. It's not that the commercial risk disappears, it's that the payment risk gets converted from counterparty credit risk into documentary compliance risk. And that's actually good news because your team controls documentary compliance. You can fix it, you can train for it. That's what we are going to talk about. Here's the paradox that sits at the heart of this briefing. Credit default rates under LCs are below 1%. That's the good news. The bad news? First presentation refusal rates globally are estimated at between 65% and 80%. Let that sink in for a moment. Roughly two-thirds to three-quarters of all LC document presentations are refused the first time they're presented to a bank. That's not a small problem. That's an industry-wide operational failure. What causes these refusals? Timing errors, data mismatches across documents, missing originals, wrong endorsements, goods descriptions that don't exactly match the credit wording, ports named incorrectly, insurance certificates dated one day after the shipment, onboard notations that are technically defective. Not one of those causes is counterparty insolvency. Not one of them is market failure. They are all self inflicted operational errors inside your own organization or among your freight forwarders, shipping agents, and insurers. Executive insight here is that the payment risk your teams face most often is not the buyer defaulting, it's your own process failing at the document stage. That's both sobering and empowering because it's within your control. Let's map where the failure traps actually sit across the trade cycle. Because the mistake that kills payment isn't always made at the document preparation stage. It often starts much earlier. Stage 1 is the contract stage. This is where poorly negotiated Incoterms create problems downstream. If you agree CIF, but your freight forwarder doesn't understand what that means for insurance responsibility, you'll find out the hard way When the insurance certificate doesn't match, stage 2 is LC issuance. This is where LC wording gets copied from previous deals without checking whether the product, route, or counterparty is different. We see this constantly. Template LCs with the wrong port names, outdated document requirements, impossible certification demands. Stage 3 is the production and logistics stage. The shipment is underway and something changes. Vessel substitution, port omission, cargo consolidation, but nobody checks whether the LC needs to be amended to reflect those changes. So the documents describe a shipment that doesn't match the LC. Stage 4 is document preparation. Invoice says one thing, packing list says another, BL says something else. Nobody cross checked them against the LC. Stage 5 is presentation, where missing originals, late courier deliveries, or missing deadlines kill the presentation after all the hard work. And stage 6, the bank examination stage, is where the issuing bank finds all of the above and refuses. And when the waiver cycle begins and payment slips by days or weeks. The chart on this slide shows the funnel, and it's deliberately illustrative, not prescriptive. The point is that risk accumulates at every stage, and by the time you reach bank acceptance, the damage is already done. Let's go through the 5 error categories, and I'll tell you upfront. Error 1 is both the most avoidable and the most common. Timing failures. These are calendar errors. They are completely preventable, and they still happen every week across UAE trade companies. The most common timing failures: the latest shipment date is exceeded because logistics overran. The presentation is made after the allowed period, typically 21 days from the shipment date, but it varies. The LC expired before the documents physically reached the nominated bank. Here's one that catches people constantly: insurance documents dated after the shipment date. The LC says goods must be insured before the date of shipment. The insurance certificate is issued the following business day. Bank refuses. And amendment timing is a killer too. A company gets an LC, realizes the dates are tight, requests an amendment, and then ships before confirming the amendment has been accepted by the issuer. The amendment is irrelevant. The original terms apply. Let me give you a concrete example. Goods shipped on 28th March. LC requires presentation within 21 days and expires on 15th April. That gives you until 18th April by calendar. But the LC says 15th April is the expiry. So you actually have until 15th April. Courier delay pushes bank receipt to 16th April. Bank refusal is technically valid. The goods are delivered, the buyer has them, but payment is contested. This is entirely avoidable loss. It requires nothing more than a deadline calendar and someone whose job is to track it. Error 2 is data mismatch. And this one is particularly frustrating because it's always discovered at the presentation stage after all the work is done. Under UCP 600, the rules that govern most documentary credits, there is strict data consistency required. The description on the invoice must be consistent with the LC. Port names must match. Party names must match. Not approximately, exactly. Think about something as simple as company names. ABC Trading LLC and ABC Trading L.L.C. These are technically different. A bank examiner who is following the rules has grounds to raise that as a discrepancy. It shouldn't happen, but it does. Quantity mismatches are common. Sales invoices show 100 metric tons. Packing lists shows 100 MT. BL shows 100 tons. Three different documents, three different formats, all describing the same cargo. Discrepancy raised. Incoterms are another one. The invoice quotes CIF port Jebel Ali. The BL freight status says freight collect. These two are contradictory. Under CIF, freight should be prepared by the seller. The examiner flags it. Here's an example I've seen in practice. A sales team updates the invoice product description mid deal from industrial polymer resin A12 to polymer resin grade A12. The LC says the former, the invoice says the latter. The bank raises a discrepancy. The goods are identical. The commercial deal is fine, but payment is held up for 3 weeks while the waiver is sought. The fix? A simple cross check document. Before presentation, someone sits with the LC in one hand and every document in the other and verifies every data point against every other document. Error 3 is transport document failures. And in the current Gulf routing environment, this category has become significantly more dangerous. Bills of lading are technically complex documents and they have to be exactly right. Shipped on board notation is required by most LCs, and the notation must confirm the actual onboard date, not just the issuance date of the BL. If the carrier's system generates the BL before loading is complete and the onboard date is missing or wrong, you have a discrepancy. Consignee and notify party wordings must match the LC exactly. Many LCs name the issuing bank as consignee. That's how the bank retains title until payment. If the freight forwarder gets that wrong, the title structure of the whole transaction is compromised. Transshipment and partial shipment are particularly relevant in 2026. With route disruptions in the Gulf, carriers have been substituting feeder vessels, changing discharge points, and doing partial loads. If your LC prohibits transshipment, but your cargo goes into a feeder vessel at a transshipment hub, that's a discrepancy, even if the cargo arrives safely. And here's the Gulf specific point. When vessels divert because of conflict risk, and we've seen this in 2024 and 2025, the BL routing changes. Port of loading might change, port of discharge might change. If nobody updates the LC via amendment to reflect those changes, you are presenting documents that describe a different voyage than the LC authorized. Freight prepaid versus collect is another one. If the LC says CFR, cost and freight, and the BL says freight collect, that's contradictory. The bank will refuse. Error 4 is the one that has grown most dramatically in 2025 and 2026. Sanctions and compliance overlays. Here's something that catches executives off guard. A document set can be technically compliant under UCP 600, every field correct, every date right, every description matching, and the bank can still hold payment. Why? Because compliance and sanctions screening sit on top of documentary compliance. They are separate processes. And the current Iran related escalation environment, banks are running enhanced screening on vessels, on ports, on correspondent banks, on intermediaries, on anything connected to the transaction. What triggers enhanced screening? Vessels that have been near Iranian waters, ports with dual use risk, correspondent banks in jurisdictions under OFAC or EU scrutiny, counterparties with names that partially match sanctions list, even if they are different entities. And the complexity escalates when routes change. If your cargo reroutes around a disrupted corridor, it might go through a port or transit jurisdiction that triggers additional screening. Your shipping agent changes the feeder vessel at short notice. That vessel has a flag or ownership history that your bank's compliance system flags. Senior executives need to be clear on this. Document compliant does not mean funds immediately releasable. These are two different gates. And the compliance gate has no fixed timeline. It can hold payment for days or weeks. The practical implication is that your trade compliance function needs to be embedded in the LC approval process, not consulted after the fact. Error 5 is where it all starts, and it's the one that creates every subsequent problem downstream. Weak drafting, bad LC language, terms that are copied from previous deals without anyone checking whether they still apply. And this creates what I call good faith failure. Situations where everyone is trying to perform correctly, but the LC itself is designed in a way that makes clean performance almost impossible. Over documentation is a big one, requiring 10 certificates when 3 would suffice, demanding original documents that in 2026 are simply not issued as originals, digital native documents, electronic BLs, digital certificates of origin. These are the documents which you don't get as originals. The LC was drafted by someone who last did trade finance in 2015. Ambiguous wording. Full set of clean documents. Clean meaning what exactly? Physically clean, legally unencumbered, without notation. Examiners interpret these things differently. Impossible timing. This is very common right now. Transit times from Asia to the UAE have lengthened. Port clearances are slower. And yet, LC shipment windows are still being written based on pre disruption assumptions. A 10-day shipment window that assumes direct loading is now 15 days because of feeder routing and the LC hasn't been updated. And the most common one of all, copy paste from the last deal. Same product, same counterparty, same route. We'll just reuse the old LC, except the production specification changed, or the Incoterm changed, or the port changed, and nobody noticed until the bank noticed. The fix is straightforward. Every LC must be reviewed from scratch against the specific deal, not against the last deal, this one. Let's talk about money, because ultimately that's why this matters to the board. When a document presentation is refused, it's not just an operational inconvenience, it has a direct impact on working capital. And in a high freight cost environment like 2026, a single refused presentation can turn a profitable trade into a loss making one. Payment delay means your receivable stays increase. If your finance facility is structured against receivable collections, delayed payment means your borrowing capacity is constrained. You are effectively self financing the extended receivable at a cost. Meanwhile, the goods may already be at the destination port. The buyer might already have them depending on the shipment terms and how release was handled. But title and payment leverage are now muddled. You have lost your strongest negotiating position. Then the costs accumulate. Demurrage if containers are sitting at port, detention charges, warehousing if cargo needs to be stored pending resolution, bank charges for each amendment, courier charges to resubmit documents. These add up to thousands of dollars per transaction. Look at the margin erosion illustrated in this slide. You start with your base margin, then you absorb the freight war risk surcharge, $1,500 to $4,000 per unit. The bank fees, $200 to $1,500 depending on the complexity. Then demurrage, $500 to over $5,000 depending on how long the dispute runs. Then forex movement if the delay crosses a month end. By the end, a thin margin trade is a loss making trade. This is not a theoretical scenario. It is happening in UAE trading companies right now. Let's look at the data points that frame this moment specifically for UAE businesses. 20% of the world's oil passes through the Strait of Hormuz. That single figure makes every Iran related development a direct trade risk for the UAE. It's not peripheral, it's central. ICC trade register data shows import LC default rates at 0.29%. That's the 2021 figure, the most recent confirmed number. Export LC defaults at 0.05%. These are extraordinarily low credit risk numbers. The instrument is safe. The problem is not credit default. The problem is operational failure, as we've discussed. China to UAE spot freight rates have risen 5% since mid February, sitting at $1,572 per FEU. And that's just one corridor. Rates from South Asia, from Europe, from the US West Coast to the Gulf have all been affected. The chart on this slide shows the 2026 conflict surcharges side by side. Hapag Lloyd at $1,500 per standard TEU, $3,500 for reefer and special cargo, CMA CGM at $2,000 for a 20-foot dry container, $3,000 for 40-foot, 4,000 for reefer and special. These are not negotiable. They are published war risk surcharges applied across the board. What this data tells you is trade finance discipline pays. In a high surcharge, high scrutiny environment, companies that get their documents right first time, every time, have a measurable advantage in cash conversion cycle, in bank relationship quality, and in commercial credibility with their counterparties. Let me bring this to life with a UAE specific case. This is a composite based on real transaction patterns, typical of what happens in mid market UAE trading companies. A UAE importer is buying industrial equipment from Asia. The seller, nervous about the Gulf insurance situation, insists on an LC rather than open account. The deal is agreed, LC is issued. Shipment departs on time, but here's where things go wrong. The carrier substitutes a feeder vessel at the transshipment hub. The BL shows feeder routing and a slightly different discharge wording, not exactly what the LC specified. Nobody in the importer's operations team catches this before the seller presents the documents. Then the insurance certificate, issued the day after the shipment date. LC required the insurance to be effective from the shipment date. It wasn't. One day late, discrepancy raised. And the packing list. The seller's team used a different quantity format than the invoice. 100 MT versus 100,000 kg. Same cargo, different presentation, discrepancy raised. The issuing bank, the UAE Importers Bank, raises three discrepancies. The supplier seeks waiver from the importer. The cargo arrives safely. Production continues. But now the importer is in a negotiation about whether to accept discrepancies, which means waiving the right to refuse payment on documentary grounds. And the importer pays additional bank charges for the amendment and resubmission cycle. The business lesson here is not about the goods, it's about documentary governance. The importer's team needed to review the BL routing change and trigger an amendment the moment it happened. They didn't. That one miss cascaded into three discrepancies and a 5-week payment delay. Second case, now from the exporter side, and this one illustrates a governance failure that I see in probably 40% of mid-size UAE exporters. A UAE exporter agrees a sale to a frontier market customer. The customer requests an LC. The sales team is pleased. LC means payment security. The deal is closed. Sales negotiates good commercial terms, price, quantity, delivery, all agreed professionally. But here's what happens next. Sales sends the LC details to operations and says, arrange the shipment, we are ready to go. Operations starts arranging logistics. Nobody goes back to the LC wordings to check whether it's actually executable. Specifically, the LC requires an inspection certificate in a very precise format, issued by an accredited third party inspection house, signed by a qualified surveyor with specific wording about grade and specification. The exporter's usual inspection vendor, a perfectly credible firm, cannot issue a certificate in exactly that format. They've never been asked to do that before. Shipment proceeds under time pressure. Documents are presented with a wording variance on the inspection certificate. The negotiating bank spots it. Payment is delayed. And here's the twist: the buyer, who asked for the LC in the first place, now uses the discrepancy as commercial leverage. I'll waive it, but I want a price discount. Or I'll waive it, but you give me extended payment terms. The seller has handed over negotiating power by failing to execute cleanly. The lesson here is that every LC must be checked for operational executability before the deal is confirmed, not after, before. Sales cannot close deals that treasury and operations cannot deliver. So, how do you fix this structurally? Because individual training is not enough. You need governance, process controls that catch problems before they become payment failures. First, LC approval must be cross functional. Every LC should be seen by sales, procurement, treasury, legal, logistics, compliance, and operations before it's accepted by business, not sequentially, in parallel, with a defined checklist and a defined escalation authority. Second, pre issuance review. Before your bank issues an LC on your behalf as applicant, or before you accept an LC as beneficiary, there should be a mandatory checklist review. Is the shipment window realistic? Is every required document obtainable? Are the port names correct? Are the inspection certificate requirements executable with your approved vendors? Third, non standard clauses must be escalated. Any clause that deviates from your standard template, any sanctions sensitive geography, any unusual vessel or route requirements goes to a senior decision maker, not operations, not the sales team, a designated authority. Fourth, measure your discrepancy rate. This is the single KPI that tells you how your LC process is performing. Track it by business unit, by counterparty, by bank, by document type. If you don't measure it, you can't improve it. And the heat map on this slide tells you where to focus first. Data mismatch, primarily a sales problem. Transport docks, logistics and external providers. Sanctions and compliance, finance and bank together. Each discrepancy type has an owner. Assign it. This slide is your board mandate list. 10 points that should be embedded in your standard LC process. 1. Confirm the LC mirrors the sales or purchase contract. Exactly, not approximately. 2. Test whether every required document is realistically obtainable. Inspection certificates, certificates of origin, phytosanitary certificates. Check that your vendors can provide them in the format required. 3. Check shipment dates against actual production lead times and current transit realities, not last year's transit times. 4. Align Incoterms, freight status, and transport document wordings. If you are selling CIF, your BL freight status must say prepaid. 5. Confirm names, addresses, quantities, and product description across all document templates before you start. One master reference document, everyone uses it. 6. Validate sanctions and compliance screening on all parties, banks, vessels, and routes before the LC is issued, not after. 7. Define amendment authority. Who can approve an amendment request? What's the turnaround time? Who communicates with the counterparty? 8. Pre-clear special clauses with logistics providers and insurers. If the LC requires a specific certificate format, show it to your provider before you sign the deal. 9. Four eyes review before every presentation. One person prepares the document. A second person checks them against the LC. No exceptions. 10. Measure post-deal discrepancies and feed them back into your contract drafting template. Make the learning systematic. Now let's make this actionable. Here's a 90-day program that any UAE corporate can run regardless of size, regardless of which bank they work with. In the first 30 days, your objective is to understand where you actually are. Assess your current LC volume. How many LCs per month? What's your discrepancy rate? If you don't know your discrepancy rate, that's your first finding. You are not measuring the right thing. Identify your top 10 recurring discrepancy causes and define an escalation matrix for geopolitically sensitive trades and sanctions adjacent routes. Days 31 to 60 are about standardization. Build a clause library, approved wordings for your most common products, routes, and counterparty types. Train your sales, procurement, logistics, and finance teams jointly in the same room on the same scenarios. This cross functional training is critical. And introduce pre presentation document scrub control. Even a simple checklist signed off by a second reviewer will reduce discrepancy rates measurably. Day 61 to 90 are about measurement and escalation. Build a dashboard. Track discrepancy KPIs, waiver cycle times, bank charges, and delayed payment value. Review your bank panel's trade finance advisory capability. Not all banks in the UAE are equally strong on LC technical guidance. And report to your executive committee with a quantified avoided loss figure. That number is the business case for maintaining the program. 3 months, manageable, high impact, and the ROI is visible in your DSO figures within a quarter. Let me close with the two principles that frame everything we have covered today. First, in the current UAE trade environment, LCs are increasingly preferred because they create payment comfort in a corridor shaped by war risk surcharges, shipping disruption, and heightened compliance sensitivity. That demand is going to continue. Gulf trade risk is not going away in 2026. Second, LCs only work as intended when contract terms, logistics execution, and document preparation are managed with precision. The instrument is sound, the failure is always in the execution. In 2026, documentary excellence is a competitive advantage. The companies that consistently present clean documents on time, that have the governance structure to execute LCs without discrepancy, those companies collect faster, negotiate from strength, and carry less working capital risk than their peers. That's not a theoretical argument, it's measurable, and it's within reach for any organization that treats this as the enterprise control issue it actually is. Thank you. I'm happy to take questions.
Thank you, Mr. Niraj Kumar, for an excellent, insightful session. Today's discussion has highlighted a very important reality in international trade. While letters of credit remain one of the most effective instruments for securing cross border payments, their success ultimately depends on disciplined execution, documentary precision, and strong internal controls. In today's geopolitical and trade environment, where supply chain disruptions, sanctions compliance, and operational risks continue to evolve, these insights are more relevant than ever. On behalf of Prudence, I would like to extend our heartfelt appreciation to our distinguished speaker, Mr. Niraj Kumar, for sharing his extensive knowledge, practical experience, and valuable perspectives on letters of credit, trade finance risks, and payment failure prevention. His real world insights and executive level guidance have provided us with actionable lessons that businesses can immediately apply within their organizations. We hope that today's session has helped you better understand the common errors, risks, and payment failure traps associated with the letters of credit, and more importantly, how to avoid them through stronger governance, collaboration, and operational excellence. This webinar presentation is now available for access on Prudence Business School website reflected on this slide. Also, feel free to share this webinar access to your department and business colleagues. On behalf of Prudence, I wish you continued success, safe trading, and prosperous business growth. We also look forward to welcoming you to future Prudence Business School executive briefings and knowledge sharing sessions. The floor is now open to participants, and let us start the Q&A session. Also, for those who would be interested in scheduling a follow on confidential one on one advisory dialogue meeting for your business, please feel free to contact me by email. Thank you very much and have a wonderful day ahead.